Macro indicators, micro, maybe taxation, and so much more to talk about. With a very special guest, Sridhar Shivram, Director at Enam Holdings, joins us right now on the show. Sridhar, thanks so much for taking the time out and joining us on Bloomberg.
Thank you for inviting me.
Well, arguably the talking point on everybody's mind is the union budget. But hey, the question is there so much impact on the markets that this budget can create, aside of maybe two key issues? One is if he overshoots even 3.5 on the fiscal deficit, and two, if LTCG makes a comeback.
Yeah. So if I look at the last 20 years history of budgets, it's a media hype. I want to be very frank on this. Barring one or two budgets have never had a significant impact on the markets as such. And even so this year, because the entire indirect taxation is taken off. So what you're left with is only the direct taxation part. And even there, I find that the government has been very proactive in making changes to direct tax when it is required during the year. Like they made some changes for the IBC process, which got completely ignored by the media. But some significant changes were made during the year to help companies bid during the IBC process, including carry forward of losses. So the point I want to make is that the whole process is overhyped by media. And I don't think that reforms, at least for this government, is restricted to the budget speech. We've seen enough happening during the year itself. So I won't put so much importance on the budget. It's one of the announcements which will come. And as you mentioned, direct tax is the only thing which is left, which is of any significance.
Yeah, but if that does come about, it'll become a really big thing, right? So, I mean, while we talk about it as not having had significant impact on headline markets, one or two reforms here and there from a sectoral perspective in the past, or one or two key things, if they do come about in this year's budget, could well have a telltale sign of a big impact. Yeah,
so as you said, maybe the fiscal deficit number is something which people are looking at it with microscope. Somewhere in the 3% handle, I think the market should be able to digest that. Not an expansionary budget, somewhere in that range, maybe plus minus 0.1 or 2% should be in line with what the market's expecting. And I don't see too much maneuvering as far as taxation is concerned, because I don't think they have enough fiscal leeway to tinker around too much. And this being the last budget, I don't think they will make too many changes. Whether LTCG comes or not, this is a debate we have every year during this time of the year. I'd be happy if something happens this year so that the debate stops from next year onwards.
Really? You'd be fine with an LTCG coming into play?
I mean, if you ask me, obviously the answer will be no. But even if it were to come, I don't think it's earth-shattering in that manner. I mean, if some taxes has to be paid, so be it. But I think the suspense is more killing than the fact that there is a tax or not. So I'd be happy. So if you go back and see what happened to the Mauritius and Singapore taxation, FIs were not paying any tax when they were coming through Mauritius and Singapore. And the whole presumption was, if you tax, the markets are going to collapse. P-notes are such a huge percentage. FIs will flee from India. Hey, it came and went. We didn't even notice when it happened. All the FIs are paying tax from this year. So all I'm trying to say is that this is really an overhyped hypothesis that if you're going to tax, the entire market is going to collapse. It's a taxation on the gain. I'm not saying that it is required at this time.
Sure.
But all I'm trying to say is that even if it were to happen, it is not as if the entire market's hypothesis is based on that one long-term capital gains taxation. There's much more to an India story than just that.
True. No, maybe the argument always is about what's the near-term impact that such a move can really bring about. I mean, the two or three people aside of who we've spoken to from a market's perspective are all saying that, hey, it gives us a buying opportunity that we've been seeking so far and haven't really gotten. There's so many people sitting on cash. By the way, so while we're on the topic, are you on cash? A large portion than otherwise?
Given the nature of the fund that we manage, we'll always have some cash. We don't have any NAV pressures or peer group pressures or anything of that sort. So it's tactical. We would look at keeping some cash based on how we see opportunities.
But higher proportion than normal?
No, I think it's broadly in line.
Yeah. Okay, great. Okay, then let's come to the moot point. How are you feeling about the markets currently? The simple definition is valuations are maybe a bit more stretched than otherwise. But are there opportunities still out there wherein people can put large quantum of money at work? Or is it prudent to maybe wait for either a valuation correct or an earnings uptick to pick up? Or or both happening together? I don't know.
So there are always opportunities in the market. We do find enough opportunities in the market. Having said that, it is a fact that some of the mid and small cap stocks have really rallied. So one has to be cautious. And this happens typically in every sort of a bull market where you see excesses at some places or the other. So I cannot say that there are no excesses in the market at all. But at the same time, there are enough opportunities that we find even in the large cap spaces, even thematically. So I don't see any issues with finding opportunities in this market. So there are enough and more, I would say.
So, okay, let me ask you to don a hat of not really the director of ENAM who wouldn't mind going completely bottom up and not having too many large cap opportunities, but from a fund perspective, let's say. Is this market looking stretched from somebody putting large quantum of money at work currently? Because unlike you, a lot of people have compulsions of how relative markets perform, so on and so forth as well. From that perspective, is it looking a bit stretched?
I won't say stretched, but if we get earnings growth which is expected for the next year, then this market would be in line with, I would say it will be like maybe just under fair valued. Okay. So I won't say it is stretched at this stage.
Okay.
But we are also basing this on the assumption that we would see strong earnings growth next year. So I would caveat it there. And at this stage, when I speak to companies, there are at least clear indications that there is more than green shoots. I mean, we've seen enough green shoots in the past 2-3 years. This time around, it's more than green shoots. And we are seeing follow through in terms of a lot of the high frequency data, be it CV numbers, we've seen FMCG volume growth data, not only YOY, Q-on-Q numbers also look strong. So many of these numbers are looking much stronger. And I guess we've had 2-3 years of very lackluster earnings growth. Keep in mind that this government has announced a substantial fiscal stimulus which hasn't been well documented. The tax cuts that have happened on the indirect tax side, some think that this is almost 1% of GDP if you do the rough numbers. Mm-hmm. And these are some of the things that, at least from our standpoint, we would have wanted to see a long time back, which is some sort of a fiscal stimulus, which is more on the consumption side. Because in our view, if the consumption goes up, because the capacity utilization for the market or the industry as such is quite low, as the consumption goes up, the capacity utilization starts to go up, and that automatically creates the next cycle. So we think that this is a healthy sign where we've had a stimulus. At the same time, the government is able to manage the fiscal deficit, so which is like a win-win situation.
Okay, interesting. So let me divide my next question into two. From here over the next 24 months, slightly longer scenario, is the stock recovery more manufacturing and economy led, or do you think it will still continue to be the rally of the consumption related names? You could argue that they had paused maybe intermediately for a bit here and there within specific pockets, but by and large consumption as a theme has been there now for maybe 3 or 4 years, maybe longer. Does that continue, or do you think manufacturing makes a bit of a comeback?
So over the last year, we've already tilted a lot towards the economy facing. And if you see, they've done very well, be it, the construction side, be it on the metals, which is slightly global in nature, but even then, cement. So our focus is currently more on the domestics than the export or the outside India piece. I think that will continue, because as the economy continues to recover, we will see more opportunities here than opportunities in the outward facing stocks. So we were bullish about 12 months back post demon on economy facing, and that has played out reasonably well, and we continue to look at opportunities in that space more than the export-oriented ones.
What about the non-economy facing consumption? Could that do better?
So consumption is a secular theme. So you would have to weigh your options based on the valuations and the opportunities in the other sectors. I wouldn't give up on consumption, because this is really a secular theme. So if you look at Barring staples, which have had their own set of issues, but say discretionary or durables, there's huge opportunities there. So you can pick and choose your stocks there. And the opportunity set is so huge given the per capita consumption is so low. That story keeps playing out. Maybe there'll be pockets during a period where it may be overstretched. And that's a portfolio manager's decision to get in or get out. I wouldn't get out at all. I would just stay put. There may be pockets of underperformance, but it's difficult to get in if you're in a large size player. I mean, that's a secular theme. These are cyclical plays, to be more precise. And you have to play those cycles.
Okay, so let's talk about a couple of secular themes and talk about the largest weightage as well.
Yeah.
I'm not including insurance as of now, but BFSI, non-insurance.
Yeah.
What's your stance now? Because the divergence in valuations, despite the 25th October run-up in PSU banks, is still fairly stark.
Yeah, so we are very bullish on the corporate-facing banks. And that's a change in stance over the last 6-9 months. We've done a lot of work on the entire IBC process. We've met people who are in the government, who are in the process of bidding, the people who are running some of these companies currently, the IBC professionals. And the sense we've got is that the bidding process may surprise the market. Keep in mind the banks have already provided 50% of the loans as provisions. Our understanding, or at least our calculation, shows that the banks may not need 50%, at least for the larger ones. And we've already seen numbers for Binani, where 4,000 crore, already there's bid for 6,000 crore. We think the large steel ones will also surprise the market. Keep in mind that 6-9 months back to today, the cycle has turned. So we know that some of the large guys have come and done a due diligence process in some of these steel companies. A lot of the details are there in the public media, so I don't need to spell out those. We think that this will surprise the market. So what happens from here is that a lot of these, so the first 12-13 cases are 25% of the NPA. These are non-interest bearing today because they are non-performing. Once these gets resolved, whatever is the balance of the loan on which the bidding is happening will become a performing loan. This will move out of the NPA. So it will have multiple impact. Not only does your balance sheet start looking better, your income generating assets starts to improve. So your income will start looking better. And I think the most important thing is most of these banks are currently engaged in the negative energy thing, which is trying to solve a problem. You're not looking at the business. Once this starts to resolve itself, you will start looking at new business. Keep in mind that there's also a capital process which is started by the government. So when I put all these things together, we think there's a huge opportunity there on the corporate-facing banks. So it could be on the private sector, it could be on the public sector. People can take their pick and choose a choice from some of these. We think there's an opportunity here. I'm not saying this is like a secular opportunity, but over the next 2 years, this will surely surprise the market. So
what part of your portfolio is this in? Is this a tactical 20% safe return portfolio category play, or are you even looking for much higher returns from some of these undervalued names, and therefore they may not necessarily be the large ones? Just trying to get a gauge.
No, given our size, most of it is the large ones. But these are not going to be 20% returns. If that be the case, I need not be here.
Sure.
If it plays out, if the thesis plays out, and from whatever we can see, a very high probability that this does play out the way we are envisaging, then the returns could be fairly significant. But there's nothing guaranteed in the market.
Of course.
So these are work that we do based on certain assumptions, certain thesis, and we'll have to see how it plays out. We think that there is a huge opportunity, especially in the financial space, especially in the corporate facing banks in particular, including PSUs.
Okay. What about the non-banking side? Where are you bullish? Where are you bearish?
Yeah. So non-banking space, NBFCs in general, we are not so bullish. When I'm saying we're not bullish, doesn't mean that it's an embargo, it's a complete no-no for everything in a broad space, because there are 2-3 events that have happened. One is that interest rate itself is going up. We've seen at least 100 basis points increase in the interest rate. this does have an impact on NBFCs in general because their cost of liability does tend to go up. The second event, of course, is that once this entire IBC process gets resolved, the large part of the PSU banks will come back into the market today, which has been vacated. So there'll be some competition. I agree that some of these NBFCs are in niche areas, so they may still continue to do well. And three is that the valuation, some of these NBFCs are already quite stretched. So the risk reward from this point of time looks slightly stretched. And I would say in particular, housing finance companies in particular, where many of these housing finance companies, again, I want to say that it doesn't mean all housing finance companies. I'm just saying in general, housing finance companies where the valuations are. And if I look at some of their portfolio, many of them have, mortgages only about 60% or 55%. The rest of it is LAP or build a loan or many of the other sort of products which are there. The other thing which is shocking is of course the RBI report on affordable housing, where they have pointed out that almost 10% NPA in the 2 lakh category and about 4.5-5% in the 5 lakh category of affordable housing. So when I speak to companies, the opportunity that they cite to me is affordable housing is a very exciting space. But RBI is giving me a red flag here, saying that there's huge NPA creation out there. So I think it's difficult to marry this entire thing of very high valuations for HFCs and the risk of an NPA which RBI is flagging. So I think there are other opportunities in the financial space, so I don't need to really worry so much about the NBFCs in general.
Okay, since the final question really, and we have an insurance company coming up as well in just moments from now, that's a bucket that has been created, maybe at higher valuations. But what are your thoughts here from a really long-term perspective? Does insurance still provide?
So I have a very contrarian view on insurance.
Oh, you do?
Yeah, I think, again, this story doesn't add up to me. Because the most important number for an insurance company that I will look at is the 61-month persistency ratio, which is after 5 years, how many people are still paying their insurance premiums. That number is shockingly at 50% for the industry. I mean, at 50%, you cannot make money because you would tend to make money only if your client is continuing to pay for 7 years, 8 years, 10 years.
Sure.
The other shocking part, of course, is that insurance itself is, life insurance in particular, is actually an over-penetrated product in India. So when we look at financial products and look at the per capita, that's how financial products have to be looked at, which is you have to look at per capita penetration for products. So when I look at mutual fund per capita penetration, which is if I compare say, us at $2,000 and say Korea at say $20,000, obviously the penetration will be different. So as we increase in per capita, the penetration improves. So when you draw that chart of emerging markets with per capita for all the financial products, almost all products, including retail loans, you take any product, mortgages, everything looks under-penetrated for India. The only product which looks over-penetrated is life insurance. And the third data which I will give you is that the total number of outstanding life insurance in India is roughly 250 million, give and take. You can check with your insurance expert who comes in here. And the total number of households in India are, say, 250 million. And out of that, if you say insurable are only about, say, 100 million, you're talking of 2.5 life insurance policies per household already. Whichever way I look at it, it just doesn't add up. And one of the arguments against this, which is given to me often, is that India is very under-protected. The protection as a percentage is very low, which I completely accept. But then, hey, the industry is selling ULIPs, which is not a protection product anyway. So if you tell me that protection is low and then you're going to sell protection products, I buy that argument. But the industry, it's a push product. So people will buy what you sell. You're selling investment product and you are telling me that protection is low. And then you're trading at 4 times embedded value, which itself is basically a present value of future profits. I mean, it just doesn't add up. I mean, I have better opportunities in other sectors in the financial market. I know it's a new sector which has come up and people are, very enthused about it. And again, I'm saying that this is not for all the companies. There are certain companies whose 61-month persistency ratios are higher. So one has to look at these numbers very carefully. I would look at 61-month persistency. Many companies don't even disclose it.
Important points to ponder as well.
Yes.
Sridhar, so good having you. Thank you so much for taking the time out and being with us. This could have gone on out of time completely though. But thanks so much for joining me today.
Yeah.